Regular people have absolutely been caught in the crossfire of politicians trying to tax the rich more than they already do. And some of us are just trying to work extremely hard to make a come up into a more comfortable lifestyle. But we are being hindered with what feels like an ever-growing excessive amount of tax. Especially here in Ontario, Canada, where the top tax rate for regular employees is now 52%. So when it comes to generating income, we may have to start looking at some more tax-advantaged sources of income if we can get them. In this video, I'm going to talk about one very specific source of income that is extremely powerful if understood and executed correctly. And it's also generally taxed at half of what employees are taxed at. This income source comes from selling cash secured puts. Now, most investors are already familiar with this type of income, but what if I told you that many people are missing one critical element? And this element, in my opinion, if understood correctly, has the potential to turn many people into millionaires much sooner. I'm gonna give that secret away right here for free with examples. No paywalls, no expensive courses. You're watching More Money? Let's get it. What's up, guys? Thanks so much for tuning in. You're watching the #1 channel for people that want to retire early. Now let's jump right into it. The element that I was referring to in the intro is the instantaneous compounding effects of selling long-term to maturity cash secured puts. Now, before I get into the specifics, guys, just note that the content in this video may be a bit more advanced than you're used to. If you become a little confused or it sounds like I'm speaking another language, don't worry, watch the video to the end as I will be giving examples. And then at the end, I'll also link to more amazing materials that I have on this platform to help turn you into a stock options ninja in no time. And if you feel like you need more help, join me on the Patreon. I love to speak to you and teach. We have people from all over the world with us. So when selling long-term to maturity cash secured puts or CSPs, of course you want to sell it at an acceptable premium. I would say anything above a 25% annualized return is my sweet spot. Now, of course, that will eliminate most stocks because they just don't have that level of volatility, but that's okay. I only need a few and I'm happy to research 1,000 to find one. Now, more on the immediate compounding element of longer term to maturity cash secured puts in a second. I would like to say that I truly believe that these instruments in conjunction with an overall portfolio strategy can be a value investor's strongest weapon for insane amounts of income generation. And since I began selling these types of cash secured puts, I've always made more from doing this than from my employment income. So more than doubling, tripling, and even quadrupling your salary is absolutely possible. Now, I didn't say that to brag, I just wanted to say it in context to what we're talking about here. And it's taxed differently as CSP income is rightfully seen as a capital gain and not employment income. So in Canada, the capital gains tax rate is half the regular rate. So not only are you able to double your income, but that income that you are doubling with is taxed at half the rate of your employment income. Now, personally, I have been doing okay here, and I really hope to 10x my annual salary with CSP income over the next couple of years. So as you can see, this can be extremely profitable, but the catch is that these types of opportunities are rare, and you have to be on the lookout for them. So what you're probably asking now is, what do you need in order to find these types of opportunities? 1, you have to find a somewhat volatile stock. 2, the company behind the stock needs to meet all of the Buffett 4-question criteria, which we consistently go over on this channel when we analyze companies. Note that with the 4th of the Buffett questions, I relax my rule of the share price needing to be selling at half of its intrinsic value. In fact, I really don't care what it's selling for. This is because I can target the intrinsic value price point with the cash secured put strike price and then just look at the yield to see if it's above 25%. This step usually eliminates approximately 95% of the potential opportunities because the yield of the CSP will be much lower than my 25% sweet spot that I like to target. So to sum this up a bit, you can generate acceptable levels of annualized premium at a strike price that is much lower than the price that you would actually buy the stock at today. Now, of course, it goes without saying that all investments have risk, and you should always speak to your investment advisor before committing to any course of action with your retirement portfolio. Now, before I go into and explain any further, let me just take a step back quickly and quickly explain what cash secured puts are. When most people sell cash secured puts, the idea is to enter into a promise to purchase a set quantity of a security at a specific price, referred to as the strike price, and by a specific date, referred to as the strike date. They are paid a non-refundable premium upfront in exchange for entering into this agreement. And you might ask, why would someone enter into this agreement? Well, if you feel as though that the stock won't decline past a certain price, say $10 a share, and You sell the ability for someone to sell you their shares at $5 a share for a very acceptable premium above that 25% sweet spot that I personally like. What you're really doing is acting like an insurance company. You're selling an insurance product. And because you don't think that the stock won't go below $10 a share, but you've set the agreement at $5 a share, you've given yourself a bit of a margin of safety as well, as the stock can run below your expectations somewhat, but if it never gets to $5 a share or lower, you never have to purchase the stocks. More on that in a second. So why would someone pay to enter into this type of agreement? Because they want to hedge the downside risk on their investments. They buy the stock for it to go up, but are willing to give up a bit of that return to be insured against losses. So I mentioned this earlier and I will again. By selling cash secured puts, you are the insurance company. Now let's dive deep into the concepts behind selling long dated cash secured puts that you absolutely need to be aware of. And while I'm telling you those concepts, I'm going to be giving you examples to help you learn better. Now I know personally I have a tough time learning just auditorily. That's why I'm going to try to give you examples which I'll put on the screen to help you learn in a better way. But before we jump into that, remember guys that the best option that you can take is by exercising the option to smash that like button. It really helps YouTube know that this channel provides valuable content, and thus they'll share it with more viewers. Also, if you're new, please consider subscribing to the channel. There's lots of valuable information coming out here at least twice a week. Okay, so let's dive into the concepts that you need to be aware of regarding long duration cash secured puts. There's three main items. The first concept that we have to understand is that with selling cash secured puts, there's always an inherent optimization problem. Short term to maturity or short duration cash secured puts will give you a lower absolute premium, but will typically have higher annualized yields. So in other words, there's less money in your pocket right now, but if the world stayed the same and you just kept reinvesting that principal, overall you'd make more money at the end of the year using 12 monthly cash secured puts than one long 12-month cash secured put. But of course, we don't live in a world that stays the same, and the financial markets move significantly month to month and even day to day at times. So a cash secured put opportunity that we see today may be gone tomorrow. So it may be worth it to lock it up with a somewhat lower annualized yield to ensure that we ultimately capture more premium than we would otherwise realistically get. Remember, finding the right opportunities are rare and we have to do a lot of work. So if I find a long dated opportunity that meets the Buffett 4-question criteria and has a premium yield of 25% or above, I'll lock it in. So once again, I have to reiterate because I will get people in the comments saying this. For those that say you can just find a different high yielding cash secured put opportunity next month, I would say that in my experience, it's not exactly realistic because at any given time, the number of stocks that meet the Buffett 4-question criteria and of high option premiums are very low. I only know of 1 or 2 at the moment right now. So essentially we're moving out of the classroom environment here and into the real world. And in the real world, in order to achieve our goals, we have to compromise. So that was the first concept. The second concept that we have to understand is longer term to maturity cash secured puts materially decrease your downside risk. And this is something that value investors need to take note of. There's too many old timers in the value investing community that dismiss options investing as risky betting. They're not wrong, but there are elements that actually can help make your portfolio safer. This is one of them. So let me explain because this is very important. The higher the premium that you get today in absolute dollars, don't confuse that with higher annualized yield, the lower your net purchase price is, and therefore your downside risk is significantly reduced. Look, let's just be honest here. Anything can happen. And if you're faced with the option to sell a 1-month cash secured put for $4 or a 1-year cash secured put for $36 with a strike price of $100, of course the $4 cash secured put would have a higher annualized return of over 48% with compounding, whereas a $36 premium put would have a 36% annualized yield. But the net purchase price of the two would be vastly different. This is because you get more premium upfront with the longer dated option, so your net purchase price is $100 less the $36 you received in premium, or $64 net. Whereas the $4 put gives you a net purchase price of $96. This means a lot more when you consider that since the company passed the Buffett 4-question investment criteria, it likely has very real intrinsic value. Now, if that intrinsic value is somewhere around $200 a share, you are getting a larger margin of safety in being able to purchase the stock at a net price of $64 if you are executed on it. And guys, think of it like this. This is a worst case scenario in this transaction where you're actually happy to hold the stock at a price that's much lower than 50% of its intrinsic value with a net purchase price of $64. And yes, I'm happy to give away some premium for this, notwithstanding the additional risks associated with missing the opportunity as explained in point number 1. Of course, I would be less happy to hold it at a net purchase price of $95, albeit it's still at 50% of its intrinsic value. Reminder that the intrinsic value that you've calculated is $200. So yes, you are giving up yield to use longer dated options, but what you lose in upside, you gain in downside protection, which is exactly up the alley of a value investors. We are typically more concerned with downside risk than upside potential. Now, the third concept, which I feel is the most overlooked or misunderstood concept, is the concept of immediate compounding with selling long-dated cash-secured puts. This is my main reason why I love cash-secured puts. And it's the reason why cash-secured puts can be the rocket ship to millions much sooner in life. So the concept here is that when I enter into a cash-secured put, the very nature of the investment is that I have to set aside the funds necessary to buy the shares should I get executed on them. But I'm free to use the non-refundable premium as I like. So there is the potential to earn immediate returns on that premium. In other words, I have the ability to immediately compound returns on that premium. If I just took that premium and earned, say, a 10% return on it over that year, I've essentially just compounded my premium earnings. So instead of, say, earning a premium of $100, with that additional 10%, I earned an effective premium of close to $110 over the term of that cash secured put. Now that's a pretty basic concept, and I'm sure a lot of people who sell cash secured puts are already aware of it, but I want you to hold on to your seats because I'm about to blow your mind. Other thing that I can do is set aside that premium into the same account that would be used to fund the share purchases if they get exercised, which means I can sell more cash secured puts on the same opportunity because I have more cash in that account available to buy the stocks. I then can do the same again with the premium received over and over again. Now, what exactly did I just say? Let me give you an easy example of that concept to bring it all home. Assume this company passed all 4 Buffett criteria and was selling for approximately $20 a share. I believe that the shares are worth $30 a share, but in this situation, I don't want to pay $1 over $15 a share to buy the stocks, or I don't want to pay anything more than 50% of its intrinsic value. The 1 year out cash secured puts happen to be yielding 35%. A yield this high is rare, but you can find them in many situations where the opportunities present themselves. There's clearly a downward risk on this stock, which is why the cash secured put premium is so high, but I'm a value investor who believes that over the long term, this company is worth a lot more, and I'm here for the volatility. I don't care if it goes to $5 a share, I'll just buy more. Now, I sell 100 cash secured puts at the $15 strike price 1 year out. 100 cash secured puts reflect 10,000 shares. So I have to set aside 10,000 times $15 per share, or $150,000 into the trading account. Now the premium that I get is $5.25 per share, or $52,500, which reflects a 35% annualized yield. Now I take that $52,500 and put it in the trading account. $52,500 divided by the $15 per share strike price allows me to buy an additional 3,500 more shares at a $15 price. So I write cash secured puts for another 3,500 shares. By doing that, I receive an additional premium of $18,375. I put that into the trading account also, and that additional $18,000 in the account allows me to have the ability to purchase another 1,200 stocks at the $15 per share strike price. So I write another cash secured put for 1,200 shares to generate an additional return of $6,300 of premium. I do it one more time by putting that $6,300 into the trading account and writing cash secured puts for 400 more shares to generate another $2,100. Now I'm tapped out, and with immediate compounding, I generated $79,000 using $150,000 in principal funds, which reflects a 53% return, which is much higher than the initial 35%. And here's the best part. If that share price never goes below $15 a share, you just get to walk away with that premium and not purchase any shares. Now, the downside is if that share price ran from $20 to $40, you don't get that 100% share price return. You're stuck with your 53% return. However, you would have never bought those shares unless they came down to $15 anyways, and so you're fine. Now, if the shares do go below $15 a share, you are also in a wonderful position because you get to buy a company that has an intrinsic value of $30 a share for $15. You can then just happily hold the shares if you wish. You can also sell covered calls on them if you'd like, provided the price hasn't fallen too far below the $15 per share mark to generate even more money. This is called the wheeling strategy. More on that in another video. And then of course, you can just go frolic in a field and celebrate all the money that you just made. Now, I need to caution you, the one thing that you have to be considerate of is the fact that the longer the time horizon is, the more likely it is that bad things can happen to the company. But since the company already passed the Buffett 4-question criteria, we don't have to worry too much about short-term issues that plague the company, so long as the company is sound over the long term. Now, I'll be putting out a whole new series on options investing in October. To not miss out on that, please consider subscribing to the channel and hitting that notification bell to be notified when I upload that video. I hope you guys gained some real value from this video, and I'll see you later.